You know, it's a topic nobody really wants to talk about, but for any business partnership, it is absolutely critical. The death of a partner isn't just a personal tragedy. It sets off a whole chain of financial and legal events. So today, we're going to walk through exactly what happens, step by step. All right, so let's start with the big question. A partner passes away. What on earth happens to their share of the business? Does everything just grind to a halt? Who gets paid? And, maybe most importantly, how do you even figure out what that share is worth? Believe me, it's way more complicated than just writing a check for their capital balance.
So the first thing to get your head around is that the business itself doesn't just end. Instead, in legal terms, the partnership is reconstituted. What that really means is the surviving partners can keep the doors open and keep operating, but a very formal process has to kick off to settle the account of the partner who has passed away. It's a huge shift for sure, but it's not the end of the road.
So our first section is all about closing that final financial chapter. And the goal here really is simple but super important: to make sure there is a fair and orderly settlement of everything the deceased partner is owed so that their estate gets exactly what it's entitled to. Now, before a single cent can be paid out, you have to answer a massive question. What is this business actually worth on the specific day the partner passed away? And I'm not talking about the numbers you see on the balance sheet. No, we need to find its real, current, true value to make sure that settlement is genuinely fair.
So how in the world do we find that true value? Well, it basically breaks down into 3 key steps. First up, you have to revalue everything, all the assets the business owns and all the liabilities it owes. Second, you've got to distribute any leftover reserves or old profits that are sitting on the books. And third, you have to calculate the value of something you can't touch, but is incredibly real: goodwill.
So what is goodwill? Think of it as the cash value of your company's good name. It's the reputation you've built, the strength of your brand, the loyalty of your customers. It's all the stuff that makes your business worth more than just its physical parts. And in accounting, it's treated as a very real asset that the deceased partner absolutely gets a share of. Okay, so how do you put a price tag on something like reputation? Well, a really common way to do it is to take the business's average profit over the last few years and multiply it by a number called the year's purchase. That multiplier is usually agreed upon in the partnership deed. So for example, if your average profit is 50,000 euros and you've agreed on a 2 years purchase, then boom, the goodwill is valued at 100,000 euros.
All right, let's move on to the next puzzle. It's pretty rare for a partner to pass away on the very last day of the financial year, right? So how do you fairly figure out their slice of the profits for that final, incomplete year they were alive?
There are basically 2 main ways to crack this nut. First is the time basis. It's the simple route. You just assume profits are made evenly all year. So if they were alive for 3 months of the year, they get 3/12 of their annual share. Easy. But if your business has busy seasons and slow seasons, the turnover basis is way more accurate. It looks at the actual sales generated up to the date of death to figure out the profit.
Now, a lot of smart partnerships actually plan ahead for this very situation, using a special financial tool, a joint life policy, or JLP. This is basically an insurance policy the business takes out on the partners, and trust me, it plays a huge role when it's time to settle up.
And here is the absolute crucial point you need to understand about this. On the business's books, that policy is probably listed at its surrender value, what you'd get if you cashed it in early. But when a partner dies, the firm doesn't get that small amount. It gets the full payout from the insurance company, which is often a much, much bigger number.
And this chart just shows you the massive difference. Let's say the policy surrender value on the books was 10,000 euros, but the actual payout is 100,000. The firm just made a financial gain of 90,000 euros. And here's the kicker. That gain is treated like any other profit. It gets shared among all the partners, and that includes a share for the deceased partner's estate.
Okay, so we've revalued the assets, we've calculated the goodwill, we've figured out the mid-year profit, and we've dealt with the insurance gain. Now, finally, we can pull all of these pieces together and actually settle the final account.
This table really gives you the whole picture. On the left, in the credits column, you add up everything they're owed: their starting capital, their share of goodwill, reserves, any profit from revaluing assets, that insurance gain, and, of course, their profit up to the date of death. Then, on the right, you subtract things like any money they already took out or their share of any losses. What's left is the final number.
Once that final amount is calculated and everyone's in agreement, the money is transferred into a special account called the deceased partner's executor's account. The executor is the person legally in charge of the estate, and it's their job to then distribute those funds to the heirs.
But what if the remaining partners drag their feet on making that payment? Well, the law actually has a pretty powerful protection built in for the estate. The estate gets a choice. They can either claim a share of the profits the business has made using their money, or they can charge 6% annual interest on the amount they're owed. And the best part? The estate gets to look at the numbers and pick whichever option pays them more. You know, this whole process just goes to show how incredibly important a detailed, solid partnership agreement really is. And it leaves us with one last question to think about. For any partnership out there, is your plan for a partner's inevitable exit, whether they retire or pass away, as strong and as clear as your plan for success? Because when you get right down to it, one is just as crucial as the other.